Welcome to Multiple Perspectives. This is your weekend view where we bring you the latest insights and trends in real estate investing. I'm Daniel Brereton. I have conversations with investors every day, and something that's come up a lot recently is investors wanting to understand how our Ascent Income Fund is able to achieve its returns. As a reminder, the Ascent Income Fund is an income-focused fund investing in senior mortgages managed by EquityMultiple. This past week, I was talking with a member of our real estate team who referenced a timely white paper. The report from Prudential Investment Management, PGIM, titled The Strategic Use of Leverage in Real Estate Debt Funds, helps to shed light on a key concept in the fund's management, specifically conservative use of leverage. Leverage in the context of real estate debt funds involves using borrowed capital to increase the potential return on investment. These funds typically invest in commercial real estate loans, and by employing leverage, fund managers can potentially enhance the returns for investors by allowing the fund to hold more loans relative to its equity base. So, how does this strategy enhance returns? By borrowing funds at a lower cost of interest than the interest earned on the real estate loans, funds can earn a higher return on equity. For example, if a fund can borrow money at 4%, but lends it out at 7%, that 3% additional return, or the spread, contributes directly to the fund's overall return. Now, this is a simplified explanation, but it captures the essence of how leverage can work to an investor's advantage. Leverage is a powerful tool for boosting returns. But what about the risks? Well, leveraging also means taking on more debt. With greater potential returns comes increased risks. PGIM identifies how these risks can be mitigated. One key strategy is employing conservative loan-to-value ratios. This means that the funds are cautious about how much they're willing to lend against the value of the real estate, and that can ensure a buffer in case property values decline. By keeping LTV ratios conservative, the funds can protect themselves and their investors from downturns in the real estate market. Another point to consider is that these loans are backed by real estate as collateral. This provides an additional layer of security, as the physical asset can be sold to recover funds if a borrower defaults. It's a way of securing the investment that, when combined with conservative LTV ratios, significantly reduces the risk profile of leveraging in real estate debt funds. In the case of EquityMultiple's Ascent Income Fund, we target LTV ratios of 50 to 70%. And with a conservative amount of leverage, we can enhance the net return to investors. More than just the LTV cushion and modest leverage, all of the loans in the portfolio are senior mortgages, meaning they are first in line for repayment and can take the underlying real estate in the unlikely event of default. Thanks for joining me for the Weekend View. As always, if you have any questions, you can reach out at ir@equitymultiple.com or via the link in the show notes. We'll also link the white paper that I referenced at the top if you'd like to do your own deep dive. See you next week.
This communication is not to be construed as an offer to sell or the solicitation of an offer to buy any security or provide investment advice. Any such offer or solicitation can only be made by means of the delivery of a confidential private offering memorandum. To the extent that performance information is contained in this podcast, past performance is not necessarily indicative of the future results, and all figures are estimated and unaudited unless otherwise noted.